Tommy Corbett from Carey Corbett Financial Solutions with the Clare Senior Nurse. Tommy, how are you?
Good morning, Alan. How are you?
Morning to you. Looking forward to it?
Yeah, really looking forward to it, yeah. It's always a great occasion when Limerick come to town.
Kick a dog while they're down?
I wouldn't say that. Limerick, in fairness, are never really down that too long.
And you're hoping they don't bounce back.
There's always that, yeah. But these things kind of take on a life of their own. So I think what has happened in the past, whether it's last week or last year, has no real reflection on next Sunday. So, but really looking forward to it. As I said, it'll be a great occasion. Limerick bring huge crowd, huge colour. Yeah. It'll be a huge atmosphere. So yeah, it's one of those occasions, one of those games that you really look forward to.
Yeah, that is for sure. Hopefully, if the weather's anyway like this and big crowd, hopefully Clare can make it 2 out of 2 heading into their break before the 2 away games. And wishing you and Brian and the team the best of luck. But you were here mainly for financial advice. And if you have any questions for Tommy, send them into 086 1800 964. Not on can he give you tickets for the game, just on money matters. And we're going to talk about financial considerations. We did the last time we was in your 20s, 30s and 40s. Now we're moving into the, I suppose, pre-retirement focused 50s and 60s. And you've 10 key priorities as you move towards retirement.
Yeah, so I suppose last time, as I said, we looked at 20s, 30s and 40s, and that was really about building wealth, building good habits, maybe getting a mortgage, family, that kind of stuff, maybe getting ready for college, that kind of thing, So what we find is once people head into their 50s, they're kind of looking down the tunnel now and maybe seeing a little bit of light at the end of the tunnel. And what we're kind of saying is hopefully that light isn't...
You're going to say what I'm thinking, aren't you, coming from heaven?
Well, no, yeah. Well, I was going to say hopefully that light is an oncoming train. That you are kind of somewhat set up, or you are in the throes of getting set up for retirement, and we see it the whole time. Even as early as this week, I had a client coming in his 50s, hadn't really done much about pensions, same age as myself, and he's kind of going, right, I need to start doing something now
or never.
Yeah, and he's probably at that stage in life where he has that little bit of extra cash, mortgage is paid off. You know what I mean? So he is in a position now to pump more money and start kind of looking down the road at retirement years in maybe 10, 15 years' time. Okay,
so take us through the 10 key steps that people should be mindful of.
Yeah, I suppose number one would be, evaluate or reevaluate your retirement goals. Excuse me. So kind of clarify when you want to retire. And everyone wants to retire early. It may not be possible. I suppose, clarify what's the desired level of income you need in retirement, and basically check if your current plan, if you have one, support this, and if it doesn't, you need to take advice.
Okay.
Number 2, maximise pension funding, particularly if you're a higher rate earner. So if you're paying tax at 40%, it's critical that you use that tax relief, as much as possible. So basically what that means is if you're paying 40% tax, every €100 you're putting into a pension is really only costing you 60, because you get 40% of it back, or €40 back in the 100. And as you get older, particularly for personal pensions and PRSAs, you can put more into your pension. So in your 50s, you can put, between 50 and 54, you can put 30% of your net relevant earnings, basically your gross pay, into a pension. That goes up to 35% between 55 and 59, and it goes up to 40% if you're over 60. So the reliefs are quite generous, and it is important that you do actually maximise that. If you have a company pension, maybe consider an AVC or a PRSA AVC. If you're self-employed, if you're a company director, there are huge tax incentives again to getting your company to pay into a pension for you. Or if you're self-employed, again, you're doing your annual tax returns, again, look at trying to maximise those tax relief as you go forward.
Okay, what about those, Tommy, who have their portfolios, be it investment portfolios or pensions? Should they look at reducing the risk as their retirement, that light in the tunnel gets closer, and how quickly or slowly should they do that?
Yeah, this is something I'm not a massive fan of, but again, if you're maybe in a position where you have a company pension, and a lot of company pensions, are the vast majority of the ones that I'm seeing, they have what's called a lifestyle strategy built in. What that means is that the farther they are from retirement, or the farther you are from retirement, the greater the level of risk, or the greater the level of volatility you're taking with your pension. In other words, the greater, you're in what are called growth assets, which are shares basically. And as you get closer to retirement, they switch from those growth assets into defensive assets, which is what we're called. And they're things like bonds and cash. No, I'm not a massive fan of that, but if you're not getting advice on a regular basis, it's probably the way to do it. The reason I'm not a massive fan of that is that as you get closer to retirement, it's basically when your pension pot is at its greatest, and it's in those years it has the greatest opportunity to make the greatest return as well. So if you're switching out of growth assets, there is the opportunity cost of switching into assets that are a little bit safer but won't have the same level of growth. But again, if you are part of a company scheme and you're not getting regular advice, I would say probably that lifestyle strategy isn't a bad thing. In relation to investment risk, again, it depends on your time horizon. So again, you could be in your 50s, but you may not need, your investment for another 5, 10, 15 years. So therefore, there's no need to switch risk, or switch funds from less risky assets. So again, it depends, and I would take advice in relation to that.
Okay, you want to head into your retirement with a pension pot, hopefully a significant pension pot. You certainly don't want to be dealing with or hearing that 4-letter word debt. So how can people ensure that isn't a feature of their retirement years and reduce their debt?
Yeah, again, maybe you're in a situation where you took out a mortgage over maybe a 35 or even a 40-year period, and you're not coming to the end of that till you're 65 or 70, and you might have the opportunity now to repay that a little bit earlier, up your repayments. And again, if you can do that and you're in a position to do it, I would certainly advise that after you have maximised your pension funding, etc. So basically, you don't want to be going into your retirement years with large debts. Now again, credit card debt, as long as it's maintained and paid off on a on a monthly basis is not a big deal. But mainly things like car loans, mortgages, even investment property, you want to have those paid off as much as possible before you retire. Prioritise debts with the greater level of interest. So basically your car loans, your credit cards, prioritise those, and then maybe move on to your mortgages.
Of course, many people, myself included, you'll have all sorts of types of insurance. You want to mention that a review of those would be a key aspect? Yeah,
again, okay, you need car insurance, you should have house insurance if you own a property, but things like life insurance, serious illness protection, income protection. Life insurance is really there for those that depend on you. If your dependents are no longer depending on you, if they've been through college and are basically taking care of themselves, your need for life insurance then dissipates. So an insurance review as to what you need going forward is important. And again, there may be savings to be had there. Also, even things like health insurance, you may want to increase the type of health insurance you have as you get into your later years, because obviously we're more susceptible to illness and hospital stays and that as we get older.
Okay, children and family support, Tommy?
Yeah, again, I suppose decide how much you want to help with remaining education, maybe deposits on houses or cars or whatever like that. But at the same time, you want to make sure that you're protecting your own retirement security, that basically you're not giving it all to them. You have to make sure that, yes, you want to help them out if at all possible, but not at the detriment that you're basically going to be, living off bread and water when it comes to retirement. So basically you've done your bit for them, maybe put them through college, that kind of stuff. And I think it's now you want to make sure that you're looking after yourself in relation to your retirement plans and how you're going to look financially into the future. And if you are in a position to help them out in relation to deposits and the bank of mum and dad, we've all heard about that, that's fine, but look after yourself first.
Okay, you also want to talk about the importance of not just planning up until the day you retire and the amount of money you take into that. That could disappear quicker than you would like if, within the first year or two of your retirement, you've gone on 3 round-the-world cruises and so on. Suddenly that pot dwindles. So planning a budget for your retirement years is a crucial element.
For sure. And again, okay, what we spend in retirement should be a little bit less than what we're spending, going to work every day and that. But at the same time, we don't want to be left short. We want to obviously do a bit of travel. That's the probably the aim of most of us when we hit retirement. So basically, retirement budget is very important. In other words, how much is it going to cost to run the house? Are we going to downsize? Are we going to need 2 cars, or are we okay with 1? The cost of going to work will dissipate. So, but then again, we may have increased costs when it comes to travel, as we said. So a retirement budget, I suppose maps out a realistic post-retirement spending versus income, that kind of thing. And it is important to include all your hobbies, travel, and the impact of inflation on any of these things as well.
Okay, tax planning?
Yeah, so I suppose where this where we see a little bit of this is as wealth increases, and I think we've talked about this in the recently enough, that you want to kind of have a look at, how you're going to pass on assets to family members. If you have a business, if you're maybe a farmer, how you're going to do that in the most tax efficient manner. And again, where it becomes a little bit more complicated, I would say absolutely talk to your accountant or talk to a tax advisor, but it is considerations that you need to look at as you get closer to retirement. And again, with a lot of these things, the sooner you put these things in place, the better, and probably the cost is a lot less then as well.
Okay, you don't want to be leaving it till the last minute, and then you have so many considerations to try and take care of. Refreshing estate planning? Yeah,
again, so it depends on, as asset prices go up, as debt goes down, you may want to look at things like Section 73, Section 72 type policies that basically look after inheritance tax for those that you're leaving behind. So again, where appropriate, it would be kind of, important to review that.
Okay, long-term care and health is important too.
Yeah, so again, I suppose we mentioned that in relation to health insurance. As we get older, I suppose we're more susceptible to getting ill and, staying in hospital a little bit more frequently and that kind of thing. I suppose it's important that we begin planning financially and practically for those potential healthcare needs, long-term healthcare needs like, the word is after escaping me, but long-term healthcare needs like Carey and those type of facilities, and basically maybe look at insurance policies, setting aside specific funds, maybe passing on assets so that we can maybe look at the fair deal scheme, those kind of things, that kind of future planning really.
Okay, 086 1800 964. Should you have any questions for Tommy, we'll throw one your way from someone who has a bit of extra cash every month. Lucky them. Are they better off throwing that at their mortgage to be debt free by 60, or should they put it into their pension? Which is the best route to go? Yeah,
I would always say try and maximise your tax relief on the pension first, particularly if you're paying that 40%. So you're up 40% straight away by investing in a pension if you are paying the 40% tax. So I would say pension first, maybe reduce debt second. Obviously, without, leaving yourself stretched. So if it is spare cash, great. If it's kind of not spare cash, you should always have your emergency fund and that kind of thing, obviously. But yeah, spare cash like that, maximise your pension.
Okay, brilliant advice as ever. Would you expect any less? No, we would not. Tommy, thank you very much.
Thank you, Alan.
Appreciate that. Tommy Corbett from Carey, Corbett Financial Solutions, joining us on Wednesday's Morning Focus.